Well, we come into today and it's very rare to watch an iconic brand fall like Nike just did. Now, this stock is down nearly 20%, and I want to talk through a few different things here. We are in an interesting part of the business cycle or the economic cycle where consumer discretion is definitely getting dispersed. It's all about what can you get for the dollar and what kind of living experiences can you get for the dollar. And the only thing we really need to look at is the fact that Carnival Cruise Line is absolutely smashing earnings. Now, this is one of your more fiscal conscious type of outlets when we talk about Carnival Cruise Line and the ships, where they're trying to save a dollar, but they're still trying to live those life experiences. And we're seeing a dispersion when we look at Lululemon, we look at Nike, these more expensive type consumer discretionary items are just not being bought up, and we can see that. Now, with a company like Nike, this could be a generational buying opportunity at the right price. And if you've been following the channel, I talk a lot about valuation and how some of the valuations are getting a little jacked up in this market because of the euphoric behavior taking place with the AI boom and fiscal stimulus. So let's dive in together on Nike. And by the way, if you're new to the channel, welcome in. My name is Colton. This is Compounding Capital, and we take a fundamental approach on this channel and look at long-term price action, and we're going to do that with Nike. Now, along with Nike, we're also going to talk about one stock that is kind of a high-risk, high-reward type of stock, pays a 9% dividend, and is trading right around $8 a share, and we'll get into that one at the end of this video, so make sure you stay till the end. Now, me personally, when I think about Nike, I think about Michael Jordan. Having the iconic athlete and the iconic brand together really boosted Nike's sales and really boosted the global presence of Nike. And now we're seeing competition kind of heat up here. We're seeing market share get distributed in different areas, and we're also seeing a slowing down of economy where maybe buying those $150, $200 sneakers is not a priority for the consumer. Now, the company stated after earnings that they expect a 10% decline in the first quarter. Nike initially guided for sales growth in 2025 and now strongly reversing that statement. Once again, this comes down to management execution. So what we're seeing here is a lack of transparency or a lack of understanding of the business model from management. Now, one thing I will say about Nike is this is a stock that has always traded for a pretty substantial premium. When we talk about consumer discretion, especially when we talk about the clothing side, it's usually a very low margin business. And to watch Nike trade at above 25 times earnings personally never made sense for me, but that doesn't necessarily mean I'm right. That just means that I thought the valuation was always expensive for Nike. Now, I do want to highlight gross margins did increase for Nike. This is a key metric that should keep valuations still elevated, which means that this recent sell-off could be a good opportunity for a longer term investor. Yes, sales are coming down. Is this a temporary headwind because of the consumer? Could we be heading into a recession? Could we be seeing Nike actually sell off even more? These are questions that we really can't answer, but what we're seeing is there is efficiencies picking up within the business model, even though top line revenue is coming in a little short. So here's what I'm going to do now. Now that I understand that Nike is guiding for 10% revenue decline from where we currently are, it looks like the company does right around 54 to 55 billion. I want to start plugging in some unbiased numbers and just see where we come out with. So I'm going to use my DCF model here to start digging into the nitty-gritty of Nike. So what I'm looking to do here is make over the next 3 years Nike a transition turnaround period. As the economy's slowing and we're seeing a lot of question marks with consumer discretion here, especially in the clothing side of business, especially when we talk about sneakers and clothing, it's been a very foggy picture. So what I want to do is build a tremendous amount of safety here if I'm looking on taking a risk into a position of Nike. So when I'm thinking about a rate of return for Nike, I'm definitely comfortable putting 10% in there. And then when we reinvest a 2% dividend, this could be a close to a 12% compounded rate of return year over year for Nike. Now, one thing I do like about Nike, and the reason why it trades for such a premium, is going to be the margins that the company can demand and also the clean balance sheet that Nike has. The company has over $10 billion in liquidity, cash liquidity, and $12.1 billion in debt. And what I like about seeing this debt profile is look at the debts coming down. It went from 13 to 12.8 to 12.6 to 12.1. So they are being responsible, paying down that debt. When I look at the balance sheet, this is a company that free cash flows between $5 and $6 billion. I think the profile of the company is extremely strong. So the true question with Nike is going to be the valuation and getting in at an appropriate price to build some safety, but also get a higher rate of return than the market can deliver. And so when we look at valuation compared to their peers, Nike trades for nearly double, and that's why we see these huge moves when companies disappoint. So after running my numbers, oddly enough, I get right around a $66 price target for a company like Nike. Now, I know a lot of people think this is crazy, but my goal here is not to buy good companies at okay deals. I'm looking for good companies at great deals. And so I'm trying to build enough safety to buy a quality company like Nike at what I think is a fair price. Now, with that being said, this is just a guide. Maybe I start nibbling around $72, but I save a substantial amount of cash for that $65, $66 range if it does ever hit those levels. Nike is now trading at $75.83, and I can understand maybe starting to build in a little bit here, but I would let the selling continue. I'd let the downgrades come through and figure out exactly what the future is looking like here. I don't think you need to jump in too much here, and I want to show you a long-term chart and where it's odd that my $66 price target pops up, because when we look at a longer term chart, what I want to show you guys is there's a couple lines of support that are coming in here that are pretty interesting. So when we look at this COVID low that happened, basically hitting $67 a share, but also it is a line of support when we look at historical valuations as well. And so we're approaching $73 to right around $68 a share. And this is where I think it could make sense from a technical standpoint to possibly look at Nike as a long-term buy and hold. Then that's not really far removed from where my price target of $66 is. So, I definitely can make sense between $65 to right around $70 a share for Nike when we look at it from a technical, but also we look at it from a fundamental standpoint. That was my dive into the fundamentals and technicals of Nike and where it might make sense here to take on the risk of Nike. Now, I did say I would give you guys an interesting small cap opportunity. So the company I want to point out here is going to be B&G Foods Inc. and trading for a forward PE sitting right around 9.5 times with nearly a 9.5% dividend yield. Now, this company was trading for over $30 a share and has fallen off of a cliff, and I think we can see that consumer staples have been struggling overall. As I stated, I do think this is a higher risk, higher reward type of stock, but I also think there's some safety here. When I look at the company's brands, it's actually fairly strong here. We have Green Giant, Cream of Wheat, Cisco, and many more brands, including Skinny Girl. So this company is trading what I think is pretty cheap when we look at consumer staples. Most consumer staples forward Ps are sitting 11, 12 times earnings. This is trading for a discount, and rightfully so, because when we look at the balance sheet, we're going to see some problems here. This is a company that doesn't carry a tremendous amount of cash, right around $40 to $50 million of cash, and that's where they're currently sitting now. But the total debt is what's kind of scary here. $2.1 billion of total debt is extremely high, highly leveraged company in a higher interest rate market. Not the combination I personally like to see, but what I do want to point out here is the company did have about $2.3 billion of debt, and that's been knocked down to right around $2.1 billion in debt. And this is a company that does have decent cash flow. Free cash flow sitting between 100 to 200 million, and we could see that with consumer staples, you get the cash flow kind of all over the place. But I think this is a company that can do anywhere between $75 to $200 million of free cash flow on a consistent basis, which means that this balance sheet is the biggest problem I do have with the company. The valuation seems appropriate. Most of your returns are most likely going to come in the form of a dividend, because I do think this is probably a stock that's going to trade between 8 to 12. I do think that this is going to be a stock that trades between 8 to 12 times earnings, and if they're not able to grow their earnings, then I just don't think you're going to see the capital appreciation. But with a 9.2% dividend yield, obviously, you don't need a tremendous amount of capital appreciation, roughly 1 to 2% a year, and you're keeping up with market. But considering that the stock has fallen from $30 a share down to $8 a share, I do think it's getting a little bit interesting here when it's trading at a forward PE sitting at 9 times earnings. Now, this is a company that has been paying the dividend for the last 16 years, and yes, it did take a hit with the stock price, going from 48 cents a share down to 19 cents a share. This is definitely what we call a turnaround story. Fairly levered company, trading at a substantially low valuation, has some problems here, but I think they're problems that can be fixed. So that's why I said this is a high risk, high reward type of play. As I stated, I think this is a higher risk, higher reward. I like the products that are within the company's umbrella. I like the fact that the valuation seems like it's appropriate, and I think we're heading into the part of the economic cycle where people are probably going to be doing more shopping at home, which should benefit the earnings of a company like this as we get inflation back under control. Now, of course, as I stated, this is a high risk, high reward type of name. It's highly levered right now in a higher interest rate environment, but the company does have decent free cash flow and it has a pretty good portfolio overall, in my opinion. As always, really appreciate your time, and we will see you in the next one.